Good morning and welcome to your Friday, October 11th market news update. Wells Fargo and JP Morgan officially kick off the third quarter earnings season. A robust Canadian employment report could reignite inflows into the beaten down loonie. The greenback pauses near 2-month highs after a sticky CPI print. Crude jumps by 3.5% after Hurricane Milton hits Florida and persistent turmoil in Middle East. Investors continue to shy away from Chinese stocks as more stimulus measures are awaited. University of Michigan leading indicators and the PPI updates serve as the next big tests of the dollar. Finally, the sterling finds support near the $1.30 area against the dollar after positive signs in the latest growth data. That's all for now, and thank you for watching.
Hi everybody and welcome to another daily presentation. This is the market overview for the 11th of October of 2024. These are the key events that you should familiarize yourself before starting your own trading day. The first and sole topic of the day is going to be about the kickstart, the official kickstart of the earnings season in today's session by two major US banks. So JP Morgan and Wells Fargo, two of the most prominent banks in the United States, officially set in motion the third quarter earnings season with their respective releases. Now, the latest performance data is expected to set the mood for this highly anticipated earnings cycle, as it is largely coinciding with the Federal Reserve's pivot towards looser financial conditions journey that we have seen embarking or starting at the start of September, but also a critical US election that falls within its span, which will crown the 47th president of the United States, which is the largest economy of the globe. And that in and of itself has a lot of implications about the performance of stock markets besides the earnings releases. So as for these releases from these two banks, the interesting aspects of their respective reports will most likely be the forward outlooks of these banks, and more particularly the net interest income forecasts from these top two tier companies at a time where, as we just mentioned, the Federal Reserve has severed its austere restrictive policy measures after 3 years. This is definitely going to impact the net income received by these banks, and we will see what and how they're attempting to, contain this situation with their strategic plans for going forward. So on the flip side, however, also of importance will be the lending growth projections, which on the flip side of this kind of coin, a pickup of activity is expected to take place as interest rates indeed go down, but also the overall capital market and possibly the investment banking and deal-making activity of these institutions. The looser financial conditions will benefit these kind of pillars of their activity. So again, we will see what kind of plans they have. That's why we stress the fact that the most important aspect of these reports is going to be the forward guidance of, or the outlooks that these companies have. So furthermore, updates on the stress testing procedures of these banks for their businesses, which are reasonably expected to have suffered over the past few years given these high interest rates that were held by the Federal Reserve in order to keep inflationary pressures or bring down inflationary pressures and keep them there, will be closely watched. And alongside this is going to be the plans for any cost cutting and improvement of their efficiencies or practices of their efficiencies. Okay, so analysts expect both banks to post declining earnings per share and revenue growth metrics in the third quarter of 2024. But yet again, we must stress, the focus will be ultimately placed on future projections from these two Wall Street behemoths. So again, critical information coming in. This is going to set the mood for the performance of your stock indices. Again, we're going to keep a close eye on this. And next week, we also have many other major central bank, many other investment banks releasing their earnings reports. We're going to have, which is left, Morgan Stanley. We're going to have Citigroup and Bank of America. Many others are going to be within, if I'm not mistaken, Monday, Tuesday, and Wednesday. All of them, they're going to release their reports. But after that, we're going to have a lot more others from other segments and other industries of the United States releasing their respective reports. For the time being, we're going to keep this section short, guys. Thanks for watching, and we will catch you until tomorrow's session for another brief update. For the time being, take care. Bye-bye. So, welcome guys to another webinar of our series. Today we're going to talk about technical analysis, and more specifically, we're going to dive into Fibonacci extensions. Remember, last webinar we went over Fibonacci retracements. In general, we're going to do a small overview of what Fibonacci is, where it came up from, how do, in a sense, investors and traders, economists as well, or technical analysts more specifically, have managed to amass this kind of Fibonacci sequence, create a tool which is many tools actually, Fibonacci extensions, retracements, and all the other ones, in order for them to make sure, in a sense, that this can be a viable tool, and the reason why they use it, we will discuss it in this webinar. So we're going to do a small overview of what Fibonacci is. We're going to underline the Fibonacci sequence. And after that, we're going to explain how investors manage to use this Fibonacci sequence to come up with the tools, and how afterwards to use the tools effectively when it comes to the trading. Essentially apply that to the day-to-day trading activities. Okay, so without further ado, let's get started. This is a quick risk warning and a disclaimer. I'm not going to read this. You can read this at your own time. Let's go straight to the point. So technical analysis, we mentioned this many times before. This is my way of classifying or splitting apart the mechanical analysis as a branch of trading. Give me 1 second to mute my speakers. Okay, so we have on chart and off chart technical indicators, and these indicators fall under the category of mechanical analysis. So these are pre-programmed kind of parameters that are given to the software and creates out these kind of indicators that we use as technical analysts. The other branch is charting analysis, which pretty much deals with drawing trend lines and studying chart patterns and candles and individual candles or the formation of candles. So that falls under the charting categories of technical analysis. Now we're going to talk about mechanical analysis, and we have on chart and off chart indicators. We covered in the past moving averages, Bollinger Bands, parabolic saw, Fibonacci, retracement. We've done that on the last webinar. Today we're going to do expansion, and we have off chart indicators, also known as oscillators. And we have covered in the past relative strength index, the moving average, convergence and divergence, and we're going to cover all the other a few more by the end of this series. Okay, so Fibonacci extensions. Let's do a historical overview. Fibonacci sequence was pretty much identified by an Italian mathematician named Leonardo Bonacci back in the 13th century in Italy. However, it is widely believed that Bonacci did not create the sequence, but the concept was introduced to him by Indian merchants. Now, the origins of the Fibonacci sequence can be traced back to the 6th century BCE in ancient India, and the sequence is pretty much connected to what we call the golden ratio, which is the 1.618, also known as the divine proportion. And this kind of ratio can be interestingly found in pretty much everywhere nature around us. For example, in galaxy formations, in seashells, in historical artifacts, in architecture, in flowers, in human faces, in human anatomy as well. So ancient people or people in general have generalized that for some reason our this kind of ratio is important because it appeals to something innate or hardwired within us. For some reason, as human beings, we like seeing this kind of ratio, even though we're not getting our rulers and measure stuff, and you know what, this is the perfect kind of ratio. Now, for some reason, it's hardwired within us to detect this and appreciate it as well. So it has to do again with the divine proportion. So for some reason, we are drawn to this as human beings. Therefore, that's how the story of, or the tool of Fibonacci retracement or extension or expansion or whatever that is, the Fibonacci in general concept was introduced to trading, extrapolating that we may see that in price action, okay, in the price action of any given instrument. That's how the whole idea came into fruition. So the Fibonacci sequence, in a nutshell, starts with two parameters, two numbers, the 0 and 1. These are the two prime components, the origins of the sequence. And pretty much you can create the sequence by adding each number with its subsequent number, and you get a fresh one. So for example, you start with 0 and 1 and you add them together, 0 and 1. 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3. 3 plus 2 is 5. 5 plus 3 is 8. 8 plus 5 is 13. And you got 21. If you keep doing this, you're going to get 21, 34, 55, 89, 144, 233, and it goes on pretty much indefinitely. Okay, so it's a sequence or a series of numbers that does not end. It can be extended into the future, how many times you can replicate this. So you, in a sense, in a nutshell, you add two parameters, the one you have in front of you and the one that is right before it, in a sense, and you get a new number. So that's how you can create the Fibonacci sequence. Now, when it comes to trading, once again, practitioners commonly use these ratio and related ratios to establish where the price action may head towards to when the trend extends. Mainly because if we have an instrument that has reached, for example, a fresh record high and there is no record of it before that or below that kind of level. So as traders or as technical analysts, they came up with the idea of using the Fibonacci ratios, and in this kind of case, the Fibonacci extension as a tool in order to extend the current price action into the future, attempting, in a sense, to guess or map out with this kind of parameters where the price action may head towards to in the future. Okay, it does not mean that the Fibonacci ratio or the sequence has a predictive power when it comes to trading. Okay, please understand this is not a crystal ball that gives you indications or tells you the future of where the price action is going to head towards to. It uses this kind of key ratios. Okay, it computerizes them, it quantifies them, and you get, in a sense, these kind of drawn levels with the help of this technical indicator. And we use these kind of levels as possible target areas or possible ranges or levels where the price action may move towards to next, because we don't have pretty much any other indication or data that can help us in a sense pinpoint where the price action is going to move towards to next. Okay, so that's how and that's why the Fibonacci tool was created and how it is used. So the key ratios, okay, for the Fibonacci sequence are the 0.618, the 0.382, the 0.5% level. It's also not actually on the Fibonacci sequence, but it is used with the Fibonacci retracement tool. Another key ratio is the 0.23.6. Okay, those are for the retracement ratios. In the extension tool, we have these key ratios mentioned here below. So the 1.272 or the 127.2% level. That means if 0 is the start of the specific move and 100 is the former peak, okay? And now we have seen the price action pulling back and then breaking into all-time high or crossing above that, the recent high. The 127 means it's going to go 27.2% higher, okay, than the previous high. You can conceptualize it like this, okay? And it uses these key Fibonacci ratios in order to draw these kind of levels. And the other levels are, as we mentioned, the 127.2, the 141.4, the 161.8, 200.618 is also another one, and you have plenty of them out there, but the most crucial one is the 161.8% level. Also important is the 100 and the 200%, even though it's not it does not arise, this ratio does not come up if you use the Fibonacci sequence. It's just a logical quote-unquote number or ratio or percentage that we use mainly because we see it pretty much everywhere in trading. Okay, so why do traders use these tools? The Fibonacci expansions or extensions, whatever you want to use it, is used to identify and establish potential profit target levels or estimate how far the price may travel after a pullback is finished, okay, or if you continue to make new highs. They are used to map out how the next price wave, and when we say wave, we're talking about Elliott wave theory here, could move after a pullback. Now, we're not going to go into Elliott wave theory, pretty complicated topic. It needs a lot of, let's just say, introduction. Okay, we haven't done that. So we're going to have a webinar going forward into the future about Elliott wave theory, its intricacies, or what is attempting to do, what kind of information can we draw out from. If the Elliott wave theory does have predictive ability in regards to the study of primary trends, intermediate trends, and whether the waves are making sense in the grander scheme of things. Again, we're not going to delve into Elliott wave, but the point we need to understand is that price action in any given instrument, historical data, does not move in only one direction. Okay, so you need, if you pull up a chart, you're going to see that the price action moves in zigzag kind of manner, either upside or downside or to the sideways. Okay, so prices tend to rally, and if they rally way too fast and way too hard, if you will, like, some sort of pullback or reversion towards the mean is expected. This is the principle that pretty much guides financial instruments or any given asset in the financial markets. This is not a law that is written in stone. It's just an empirical observation from traders across many generations or many decades of trading. You tend to see this kind of behavior from price action. Therefore, this is an unwritten rule that prices tend to revert towards the mean after a specific period or subjective period of time. Okay, depends upon many different parameters, but yeah, you don't always get upswings and no downswings. You tend to have waves, and that's the whole premise of how and why we use the Fibonacci retracement tool. If we assume that price action moves in waves, which pretty much do, it's pretty much evident if you pull up a chart. Fibonacci extension tool can be used in order to not predict, but map out where the next wave may move towards to and how far it can go. Okay, Fibonacci extension tool or the Fibonacci extension ratios are used primarily for that, to guess or map out where the price action may head towards to next. Again, does not have price predicting abilities. It's just a template, an overlay on top of price action, which may help us to place a target for us to exit or just map out the area where the price action might move towards to next. And if we do that, we have a sense. Doesn't mean that it's accurate. It means that we have a guiding kind of crude map that shows where it could move. Okay, and we use that accordingly. Okay, again, these are not to be trusted entirely. Okay, we're there used primarily as a supplementary kind of tool. Again, this is it. So Fibonacci extensions can be used for any given before I move to this. So Fibonacci extensions use 3 points: the start of the move, the peak of the move, and a retracement or a pullback. You're going to see what I mean by this pretty shortly. So Fibonacci extensions can be used for any time frame or any given instrument or any given market. So typically clusters of Fibonacci levels indicate a price area, not level, that may be significant into the future, but also it is a visual guide for traders in their decision-making process. Okay, much easier to plan your trade, okay, or come up with a trading system when you have at least some sort of indication of where the price action may move towards to next. It's used as a guiding principle, as a supplementary tool, rather than an absolute thing that is guaranteed to work out and come into fruition like that. Okay, so since extension levels can be drawn on different price waves over time, when multiple levels from these different waves converge at one price, this gives us much more confidence that that specific level or area is important, and we need to pay attention to that. Okay, so we do use the Fibonacci extension tool either in any given circumstance. But if you go further, if you plot the Fibonacci extension tool, it spits out these kind of levels: the 127.2, the 141.4, the 161.8. If you plot that on top of your chart, okay, and you see where the lines are drawn, and you go backwards in time, and if you do have past price action that has traversed through those levels, through those key areas, you see whether they overlay with prior levels of support or resistance, and that's primarily how we use the Fibonacci tools in general. We use them as potential areas of support or resistance. That's pretty much it. Nothing more, nothing less. Okay. Suggested price areas for support or resistance of any given instrument. This is what the Fibonacci tool, in a sense, attempts to do. Okay. That's how we use it, in a sense, to optimize our trading. So what is the difference between Fibonacci extensions and Fibonacci retracements? Pretty much in the name. Retracement, we're talking about the price action of an instrument that has rallied, has peaked, and then moves to the opposite direction of the primary move, which is upwards. This is what we call retracement, okay, or pullback. That's another way of saying this. Whereas Fibonacci extensions is, you can imagine the same scenario: primary direction upwards, a retracement occurs, and then we see the price action rallying towards the previous high, okay? And if it breaks above that, then we have what we call a technical breakout. This is where Fibonacci extensions come. So it's beyond the primary distance of Fibonacci extensions are, in a sense, what are explained by the name in and of itself, extending of the primary move towards the primary direction of the trend. Okay. So while extensions show where the price will go for a retracement, Fibonacci retracement levels indicate how deep a retracement could be. And if you remember on the prior webinar, we highlighted the 61.8, the 50%, the 38.2, and the 23.6% level as a potential. Those are the key Fibonacci retracement level areas that we do pay attention to, assessing or guessing where the price action, how far the price action is going to move to the opposite direction before it moves upwards. Okay, so Fibonacci retracement measures the pullbacks within a trend, whereas the Fibonacci extension, attempt to measure where the next leg up, if you will, like, or the next impulse wave in the primary direction of the trend. Let me see if I have a pen here ready. It does not allow me. Still, you're going to see what I mean by this. So it's a visual illustration of the Fibonacci extension, not an ideal one, but still, you see, what is this? Aussie dollar on our chart. Okay, so we see some sort of a sideways kind of price action taking place here in this kind of area. Okay, nothing major. If you zoomed out, you're going to see that the primary direction is upwards. So it came from way down here up there. So you see some sort of stalling. So we draw from the bottom to the top. This is the 100%, excuse me, the 0%. This is the 100% level. Okay, so we went from the bottom to the top, if you like. And now we use this as a guide for our retracement, in a sense. So from A to B is the primary direction. You can assume that, okay, for the impulse wave. Okay, from B to C, C is where we saw the price action bottoming out, if you like. So this is the end of the retracement. You're going to see it on the next slide. And from there onwards, we use the Fibonacci extension tool, okay, in order to see where the price action is possibly going to head towards to. And you can clearly see here the 127.2, the 141.2, and the 161.8 being the next targets, if you like, when the primary move, when the retracement ends and the primary direction of the market continues. Okay, and this is where how the Fibonacci extension tool spits out these potential areas of where the price action is going to stall towards to next. That's how we pretty much use it. And I've overlaid here Fibonacci extension and Fibonacci retracement tool. Some platforms, some charting software have these two inbuilt together. So you use the Fibonacci retracement and it spits out the Fibonacci extension levels as well. Super useful in MT4 is two different indicators, if you will like. So yeah, 0%, 100%, this is the retracement. So you have the 23.6, the 38.2, the 50, the 61.8, and we currently see the retracement finding some sort of support near the 61.8, and therefore once we get actual validated information that the 61.8% level holds, and we start to see the price action heading above the 50 towards the 38.2, and we see the formation of a cup, small cup, or a rounded bowl, or a new higher low. Okay, we use the Fibonacci extension tool in order to see, oh, you know what, we're gonna test and break above this former high level. Where am I expecting the price action with the usage of the Fibonacci extension tool for the price action to go towards to? And we have some plotted extended kind of levels here with the use of the Fibonacci extension tool. Okay, so let's move on to the next topic. Next slide, excuse me. So as we see here, we applied many other stuff to the chart as well. Our Bollinger Bands, we have moving averages, RSI as well. And this is, obviously, this has nothing to do with the Fibonacci retracement or the Fibonacci extension as a tool, but it has to do everything with your trading strategy that you're gonna use and apply when you go out there. Okay, the reason why I've plotted all these indicators onto the chart in this slide is to highlight the fact, underscore the fact that you do not use the Fibonacci retracement or extension tools individually and in and of themselves. Okay, please use other technical indicators that give you information about other aspects of any given instrument you're looking at. For example, momentum, or the strength of a move, or how bulls and bears are behaving within that specific market. Okay, for example, the Bollinger Band, how overextended or how strong the move is. Okay, is it an abnormal move? Moving averages, where the price action is trending, is it trending above these kind of levels or below them, or is it merging with the price action? Okay, you use different indicators to create, in a sense, you use different indicators in order to come up with a scenario where pretty much all of them converge and tell you the same story, because this is going to give you the highest chance or the highest probability of placing a correct trade. Once you have different indications aligning together and telling the same story, you have greater confidence at going out and deploying your strategy or your game plan, rather than just blindly using the Fibonacci retracement and extension tools and assuming that, oh, you know what, I know everything. Okay, obviously you cannot know everything at the same time when it comes to trading. Again, it's a probabilistic game. So with the usage of other technical indicators, overlaying them all together and studying them closely, okay, you essentially collect much more percentage points of confidence, and we use that accordingly. Okay, in this kind of scenario, we do not have a clear indication that the price action is gonna extend towards the upside. And how do we know this? Okay, other technical indicators confirm that. Remember, when we saw this slide without the technical indicators, we assumed that, you know what, oh, you see one bounce here, finding support, second support there. Oh, you know what, there, it's going to move to higher ground. Okay, using only this information that we have in front of us. However, the picture changes once you add other stuff to your chart, and you're going to see clearly what I mean by this right now. So for example, yes, the price action has found support here once, found support twice here, is still there. It's not, has not cleared this level yet. And we started extrapolating that it's going to move upwards. No, for the time being, we don't have a clear signal that the market is going to move to the high ground, because down here you have the RSI, and notice where it is. It's between 50 and 30. So that means the bears are in control. Okay, and the bulls are not in control. The bears are in control. So the chances of the price action moving lower are with the side of the bears. What else do we see here? Moving averages. We see price action being below the short term and the long term moving average. If you see here, we see a crossover between the short and the long term moving average, which gives me an indication that the bears are in control, then bulls are not in control. Okay, the bears are driving the price action currently. Will this change? We don't know. For the time being, we do not have a valid signal that says price action is going to move to high ground. Not yet. It might, but we're going to study this and we're going to watch this closely. And when all these clear indications arise, then we're going to start placing trades, and then we're going to have high confidence and then start placing trades. For example, what do we need to see? Okay, we make a base case scenario here. What do we need to see in order to have high confidence that the market is going to extend to its primary direction? Okay, and not just stay within trading range, because if you zoom out, this is a closed trading range. Okay, so it's a sideways price action. It's not trending to either direction on an hour chart. If you pull that out to the weekly chart, you're going to see a clear trend. But now using this, the hourly chart, we don't have a clear trend. Okay, so the chances of the price action to go upwards are not with us currently. What do we need to see? We need to see price action moving above the red line, the short-term moving average, and the line in and of itself, the red line crossing above the blue line, excuse me. That means the short-term moving average is crossing above the long-term moving average. In other words, the bulls are taking control over the bears, and they shift the short-term kind of trend in their favor. Okay, we do not see this yet. The bears are in control. We need to see price action rallying. Okay, we need to see the moving averages having a crossover, much like in this area right here, or this area right here, a clear crossover. Okay, also, what do we need to see? We need to see the Bollinger Bands. You see the price action is below the midline, is this thin blue line. Okay, thin blue line, not the bold one, the thin blue line. You see the price action is below that midline, mid-level, okay? And it's actually moving closer to the lower bound of the Bollinger Bands, okay? What do we need to see? Price action heading north of that, okay? And attempting to breach the upper bound, not the lower bound, the upper bound of the Bollinger Band, okay? This is let's just assume this is the second point I need to see before I start placing trades. Also, I need to see the RSI crossing above the 50 line, okay, the threshold, with significant strength, with resolve, with determination, okay? I need to see that the bulls have entered the market and they are in control. Now they are not. We see the bears in control, okay? So we need an RSI value of at least 50, and the more, the merrier. So for example, an idea would be somewhere around the 60 and 65%, 60 or 65 value of RSI for us to get a confidence that the bulls are indeed in control. Also, what else do we need to see? We need to see that price action forms, okay, a base, okay, a higher low is not there yet, okay? We have two touches, but it's still there. We need the price action to clear, move away from the 61.8, possibly, not possibly, but definitely above the 50, and start challenging the 38.2, okay? So this area right here, if we see a formation of a bottom, this area here would be my preferred area of entering position. And if we see the price action rolling up to this kind of level, most likely you're going to see an RSI above 50. Most likely you're going to get some sort of a crossover, at least an early crossover between the two moving averages. Probably going to see the Bollinger Bands, the price action above the midline of the Bollinger Bands and closer to the upper bound. Okay. And if let's assume we see the formation here of a new higher low, my eyesight will be on entering a position somewhere above the 38.2 level. Okay, at least clearing this area right here. Okay, I'm gonna have a stop loss somewhere in here near the 61.8, and I'm gonna have a target either 100% or the first kind of Fibonacci extension ratio at the 127.2 area. Okay, so enter somewhere in here, profit target up here, stop loss down here. Okay, this is a valid play for me. This is a play that has a decent risk reward ratio. We're going to see that on a live environment on an instrument right now. Okay, so this is how you interpret and use the Fibonacci extension tools. Okay, you use them as potential targets for exiting, and we will see the example now. Let me get my charts up and running. So what do we have here? Let me make it maximize this. No, how do you maximize this? Down here? No. Anyway, F11 probably. Yep. So what do we have in front of us right now? We have the S&P 500. Okay. We also have the ADX down here. We'll see how useful that will be pretty soon. Okay. So average directional move. So let's see and use the Fibonacci tools in order to guess where the price action may move towards to next. Okay, so this is the top to the bottom, and you get what we call Fibonacci retracement tool. Actually, you don't need this. Maybe think it's already implemented in here. Okay, so assuming that this is the primary direction of the trend, which is upwards, pretty much self-evident here. Okay, if we use that as a valid way. Okay, let me, okay, so let's enable all the other key levels, 127 to 141. I'm gonna go with, also, this is way too far, this is way too far. I'm gonna stick to, yeah, I'm just gonna stick to this, okay? So we're talking from a long point of view, so this is a daily chart, okay? So we have drawn from the bottom to the top, and you get also the Fibonacci retracement tools. We see the price action not coming back down towards, let me remove volume just for the sake of it. Okay. So what do we have here besides the rainbow of Fibonacci retracement and extension tool? So what do we see here? We see the primary move. Okay, so the first wave, if you would like. So we have from the bottom to the top 0 and 100%. Okay, and we see S&P pulling back, but the pullback or the retracement not being deep enough. Okay, it managed to find some sort of support and rebound from the 0.786 or the 78.6% level, did not even breach or come down to the 61.8 or the 5 or the 3.2. Okay, so It's relatively speaking a shallow pullback, but given that the price action has rebounded from this level, okay, and it moves to higher ground, we may see possibly another break into all-time high territory if we get a break above the 55,260 something dollars for SPY, so SPX or S&P 500. Okay, so now we use the Fibonacci extension tool in order to see where or how far the next leg is going to move towards to next. Okay, and we currently see this level, the 5,600, being is not is close to that. Where's the 5,600? Somewhere in there. Okay, so we're talking about rough numbers. So this area, and again, I'm not going to use the line. I'm going to use the what is the rectangle box? Yes, I'm going to highlight this area right here as a potential exit target for me. So let's use the long position, for example. Let's assume that we missed this kind of move. I'm going to have a target up there and a stop loss down here. So risk reward ratio of nearly 2, not ideal. The move has already cleared and moved some sort of headway. But looking at this from generic or a holistic kind of point of view when it comes to technical analysis, what do we see? Do we have the clear indication that we're going to move to higher ground? Let's see what kind of indications do we have from our indicators. Let's use this vertical line here in order for me to signify the ADX. Okay, you're going to see it down here. Okay, so positive DI is higher than the negative DI. That means the bulls are taking control. Okay, and there is they're driving the price action. However, ADX is plummeting, so that means we're not gonna we do not really expect to see a rapid kind of extension or rapid move from here onwards in regards to the price action. The price action, yes, is going to move to a higher ground. At least the technicals tell us this. And with yes, it's going to move to a higher ground, but not with the same strength as it has done, for example, in here in this kind of initial stages of the leg up, okay, where you saw a big difference between positive DI and negative DI. For example, see positive DI registering somewhere a value of 38, and the negative DI was plummeting from the 17 to 14 to 9. Okay, so that means absence of sellers. This negative DI plummeting means sellers are nowhere to be found, whereas we see a flow of bulls or buying orders in a sense. This disturbance or this how would you call it, this discrepancy, this difference between the two, buying and selling interest, okay, tells us that the move is going to be much more volatile and much more strong. And you can clearly see also the ADX picking up on that difference between the two. Okay, again, it's delayed, but still. So we are currently not witnessing any of this. Plus, the negative DI is above the threshold of pretty much the 20. So it's currently at 23.6. We need to see the negative DI or selling interest declining kind of rapidly. At the same time, we want to see buying interest entering the picture and strengthening even more in order for us to see this kind of rally up to this point in a relatively short amount of time. Okay, it's going to take some more, it's going to take more time to go to this level. In other words, that's what I mean. So ADX confirms, at least from a preliminary point of view, that the bulls are in control and there is enough buying interest. What else do we see? We see the price action being above, okay, the two moving averages. Okay, that means there is a intermediate or short-term pivot of the direction of the trend. Okay, so the trend has shifted from for a small period of time was negative. The bears were in control. Now we see the bulls re-entering the market with strong momentum. Okay. What else do we see? Other indications. Let's add, for example, RSI. What does the RSI tell us? Okay, I need to remove ADX. No worries. ADX out of the picture. And let's do RSI. Down below, what do we see with RSI? We see the RSI based moving average, okay, being below the actual RSI. So the RSI is above the RSI, the smooth moving average of the RSI in a sense. So that's definitely good news. We also see RSI being above 50. That means the bulls are in control. So we have one confirmation, second confirmation, and what else do we have? If we do Bollinger Bands, we're probably going to see price action being above the midline. So that's another clear indication. So we see also something else that is very nice is that we see a confirmation of the RSI and no divergence between the RSI and the price action. We see a low, okay, close to 30, okay. Then we see a higher low confirmed by the higher low created with the RSI. So no divergence there compared obviously to this. This is definitely divergence. You can clearly see that price action is making higher highs, whereas RSI does not confirm that at the whole stages. So yes, higher high, but this was no higher than this. So this was an early sign of divergence. Same here, another high. No, same level, another high. Okay, so this was pretty much expected, mainly because we saw this overextended divergence. Okay, so happens somewhere in here, the first stages of divergence. Price action continues to move north from there. No higher peaks on higher highs for the RSI, whereas price action does. So at this kind of stage, you would have expected to get some sort of a pullback because the strength is running a lot. Is running out of, the bulls are running out of steam in a sense, and the bears are indirectly piling up short orders. And we see once the bulls closing their positions, the bears taking control and pushing the price action to lower ground. This did not last long. This pullback did not last long, which is again another area of concern that we may see some sort of stalling price action near the all-time high before a clear break above it. So we need to take all of this under consideration. Okay, so we need to see an RSI value okay, crossing the 70 and then making new highs and new highs. Okay, so consecutively higher highs. Okay, and it needs to reflect that with the price action as well. Okay, if we get some sort of deviation or divergence, much like we have seen here in this kind of stage, sorry, this area here, if we get this no confirmance of the price action with the RSI, then we're gonna adjust at the end of the day our profit target to a lower level, but also our stop loss. Okay, if the price action rallies from here onwards, obviously we can readjust our stop loss into higher ground, okay, on a higher level to minimize in a sense our exposure, or you can place a trailing stop. Again, that's another way to do it. Okay, so hopefully this has been informative for you guys. We have covered Fibonacci retracement with extensions at the same time. Again, Fibonacci retracement, we've done that on the prior webinar. This was relevant for us to do this in today's webinar as well, because obviously we're talking about Fibonacci here. So Fibonacci extensions are again used for us to map any potential areas where the price action, if the price action of any given instrument breaks into all-time high territory or uncharted territory, and we want to measure or guess or map out where the price action may head towards to next after the completion of the wave. Okay, and after this wave is completed, where are we going to be looking towards to, for example, specific areas of exiting? That is provided by the usage of application of the Fibonacci extension tool. And again, the key levels, my own personal experience and liking, are 1.618. Okay, 1.618 is pretty much self-explanatory what it is. But obviously this is relative compared to what kind of trader you are and what kind of time horizon you do have. Okay, so if you're for example a scalper, the time frames are obviously going to be adjusted downwards, and you're not going to have, you can have a lot more noise when you do your technical analysis, okay, compared to someone that for example swing trades. Okay, they can leave a position open for, I don't know, 3 weeks, 4 weeks, a month, excuse me, a month and a half, etc. So obviously it depends upon what kind of trader you are and your time horizon, your risk tolerance. But yeah, the tool as a tool can be used pretty much by everyone. Okay, you need to adjust accordingly depending on your approach, but still, it's again Fibonacci extension or Fibonacci retracement or Fibonacci in general as a tool or tools shall not be used with the belief that they do have predictive abilities. They are not crystal balls that show you where the price action is going to definitely move towards to next. No, we're talking about probabilities here. Okay, they may move, the price action may move towards that level because we use the Fibonacci. And again, we use them as mere targets or areas that we may see some sort of resistance taking place there, or on the opposite case, if you have use the retracement tool, where we could possibly see some sort of support taking place there. Okay, obviously in an instrument like this, which is S&P 500, and we see it trending near all-time highs, is not currently at all-time highs. This is the all-time high peak. It has pulled back, but it's gearing up to break into all-time high territory. Since we don't have any past price action, okay, on the left for us to draw our support and resistance levels accordingly on a traditional fashion, Fibonacci extension tool may be the best available tool that we do have in our arsenal at mapping out where the price action may head towards to next. Again, it's not 100% guaranteed that it's going to move towards to that level. Please digest this. Use this as supplementary, or is for you to have an idea where the price action might stall, okay, in the near future. Because as we mentioned many times, again, in the past, price action does not always move to one direction with no other interruptions. Okay, you can clearly see here it moves in waves, and that's why we assume that this is one wave and the pullback, and then we assume that the extension of the next wave is going to be something like this. Okay, obviously we don't know how it's going to turn out. For the time being, our indications, technical indicators, we see an alignment that points to stronger S&P 500, so higher prices for S&P 500. So the technical analysis assessment based on what we see in front of us definitely lies on the bullish side rather than the bearish, if you would like. Okay, so at least sideways or bullish. Bullish is the main case in regards to S&P 500. Now it depends upon many different factors on whether it's gonna manifest like this, for example, financial data coming in. So the next point of reflection or reference, or next point of attention, at least from my point of view as an analyst, is going to be next Tuesday for PPI and Wednesday for CPI. So inflation, in plain words, of the United States. We're going to get an update for the month of April next week. So both Tuesday and Wednesday is going to be crucial for the development of stock markets. But yeah, pretty much here we have a bullish case for S&P 500 given the technical. Okay, so we're running out of time, guys. I think we're going to cut this short here. Okay, what to expect in the next session? If I'm not mistaken, we are doing risk management next webinar. Okay, super simple, super easy to comprehend. But the thing is, with risk management, it's easy to comprehend and conceptualize, but it's super hard to put in practice. So it needs to be, we're gonna underline a few key concepts that you need to have in the back of your mind when it comes to trading, okay, and how to assess your risk while trading. We're going to introduce a few mental kind of tricks that you can apply. We're also going to obviously talk a lot about risk reward ratio. Does it worth entering a position? Does it worth chasing a trade or not? We're going to judge that. Obviously, it's going to be dependent upon your liking and your risk tolerance. For example, I'm going to spoil this. From my personal experience, I like to go for a risk reward ratio of at least 2.5, maybe 3, in order for me to be involved or invested enough for me to enter the market and just trade this. So I don't go for trades that do not have a decent risk reward ratio, obviously, because they're not worth it. I'm not willing to risk 10% in order to get 15. That's not a viable trade for me. It might be for you, but for me, it's not. So again, we're going to introduce all of these intricacies. We're going to talk about the importance of it might sound silly, but the actual usage of a trading journal. So in a sense, for example, you place a trade, okay, you follow it up, and in a sense, you create an entry, okay. Either you can do it on an actual physical piece of paper, or you can do it manually, digitally on a PC. For example, get a snapshot of your trade, see how the price action behaved. Did we meet our target? Did we fall short? How and why did we fall short? We're going to do a small investigation. Doing this on a day-to-day basis, if you're trading, it's super, super helpful. It sounds silly, but for some reason, it helps you understand you, okay, and how do you approach your trading strategy in general? What are you looking at and not looking at while you're trading? Okay, so by writing down what you have done and what you have seen and what you, in a sense, saw and open the position, seeing what parameters do you feel that are valid or not. By doing that time and time and time and time again, you understand who you are as a trader, even though you have a glimpse or an idea in your head what kind of trader you are and how you perform. But having it down, okay, in a sense, and have evidence that points to you doing what you said you would. Okay, so for example, I'm going to have a stop loss at 5% and a take profit at 15%, so risk reward ratio of 3%, 3, yeah. And you see the price action going the opposite direction and you are in losses, and you, for some weird reason, you extend that 5% stop loss into 10%, and you go from 10% to 15%, and you start being stubborn and not closing your position. These are the stuff that are going to be seen, okay? Once you start, obviously, if you start writing on a journal, you're going to see and go back, you know what? Oh, I've acted on impulse in this kind of situation. Why? Okay. So in a sense, it's a reevaluation, continued reevaluation of who you are as a trader, what is aiding you to become profitable, what is impeding your progress or process of becoming profitable when it comes to trading, and start by then eliminating the stuff that are unnecessary or causing you way too much trouble and focusing on your strength. In a sense, it's a weird one, but we're going to introduce that on the next webinar. For the time being, enough of me about blubbering about stuff. We're going to leave it at that. It's Friday. Have a lovely trading session in today, and we're going to catch you next week. If you do have any questions, by the way, before I go, please send them through right now. If not, I see no current questions in here. If not, have a lovely weekend, and we'll catch you on to next week for I think it's going to be a final webinar. Maybe we're going to do a live trading session the week after that. But still, we'll see. No questions? Okay. Take care, guys. Have a lovely weekend. See you next week. Ciao. Bye-bye.